Time for our opening presentation of the next 2 days. The presentation is entitled Global Economic Outlook, Mapping the Road Ahead. This is going to give you the insights you need to protect and grow your business during today's volatile economic and political climate. I do want to say, before we bring up our speaker today, that there will be some time at the end for some audience participation and questions. So if you have a question for our presenter today, just make a little mental note, jot it down, and when he wraps, we will have microphones. I'll head out to the room and get you a microphone, and we can ask Stuart some questions. We want you to participate throughout the day, not just in this presentation, but in all the presentations. I know, speaking from the moderator side of things, it just makes for a very enjoyable experience if we can have as much participation as possible. With that, I want to bring up to the stage the sponsor of today's luncheon presentation, and that is Supriya Devgan. She's the Manager of Export Development Canada for BC, and she will introduce our speaker today. A round of applause for Supriya.
It gives me great pleasure to introduce Stuart Bergman to all of you. Stuart Bergman is our Chief Economist and Vice President at Export Development Canada. He has been at EDC for 20 years in progressive senior roles, and as Chief Economist now, it is his job to overlook the global economic updates and forecasting. So some of you must be wondering, what is Export Development Canada? Export Development Canada is a Crown Corp that is responsible for one and only one thing. Our mandate is to support Canadian exporters to go and succeed on the international stage. With that said, at this time, we have a lot of uncertainty happening in the market with not just the lingering effects of the pandemic, but also a war in Ukraine and surging commodity prices, record inflation. So our Chief Economist here, Stuart's presentation, will actually give us some tools to see how companies can navigate those risks at this time. With that, I'd like to welcome Stuart Bergman to the stage.
Thank you, Supriya. And thank you to Janet and to Shannon and Erin. I don't think I've ever heard a land acknowledgement that spectacular, and I think that's actually what we need to be doing a lot more of. So that was incredible. Thank you, Joe. And I noticed that, so you're a Philadelphia Flyers fan, which we'll put that aside because I'm from Montreal, so you know where I'm going with that. But what I was going to say is I hope you're not a Philadelphia Phillies fan, because each time that a team from Philadelphia has won the World Series, we've actually fallen into a global economic crisis. So let's say that for the next few weeks, we're all Astros fans, and you can become a Phillies fan again next year. Actually, that kind of is the presentation. I don't think there's a lot more to it than that. But let's get started because there's a lot to say, and I know we do want to do a Q&A, so we'll try to leave as much time for that as possible, and I do know that we're somewhat pressed for time. So, we were wrong. We were wrong. Now, if you're confused, it makes sense, because economists, we don't like to admit when we're wrong. We're not used to saying that we're wrong, but we were wrong. And anybody that tells you any differently isn't being entirely truthful with you. Right? This was supposed to be the year that the global economy recovered from the COVID shock. Coming into the year, we expected that this would be the year we'd finally be able to put the COVID-inspired downturn behind us. And so even through much of the first quarter, most economists expected that by the end of 2022, the US, Europe, China, would get back to the paths that they were on before the downturn. And so if you would have looked at the consensus forecast, what we call the consensus forecast, as recently as January, you would have seen that most forecasters were actually calling for the global economy to grow by more than 4% this year. 4.1% was the average consensus forecast back in January, as recently as January. The IMF was just totally optimistic, downright chipper. They were calling for the global economy to grow by almost 4.5%, 4.4% to be precise. And the IMF remains, I would say, overly optimistic with their views. Now, just in case you think I'm up here shaming the others, we weren't that far off, though perhaps not as ebullient as our friends over at the fund. In fact, the biggest risks we identified was that the global economy wouldn't be able to keep up with the growth that we had set ourselves. We wouldn't keep up with the growth. Growth would be so strong, we wouldn't even be able to keep up with it. Inflation, labor constraints were our biggest concerns. Because remember that in response to COVID, governments, central banks from around the world unleashed this wave of massive and unprecedentedly coordinated public stimulus measures, right? Interest rates were cut to basically zero, even below zero in some markets, below zero interest rates. Central banks loaded up their balance sheets in efforts to pump huge amounts of liquidity into the system, and the world's most wealthy governments launched these enormous fiscal stimulus packages. In fact, by some measures, fiscal and liquidity support out of advanced industrialized economies alone amounted to some 20% of the global economy. 20% of global GDP shoved back into the system in a very short period of time. But because we were in lockdown, there were actually less ways to spend that money. Right? All that money that used to go into leisure and hospitality services, into transportation, was either put away for a rainy day, and remember that, we'll get back to that rainy day fund, or went into ordering more stuff online. And I like to say that we didn't stop buying, we just changed what we bought and how we bought it. Right? How many of you swapped out that annual vacation for a new backyard deck? Come on, be honest, geez. A hot tub. Honey, we're not going on vacation this year, but I bought you a hot tub. Your daily commute to the office for a computer upgrade. So we basically went from 0 to 100 in a very short period of time, and good suppliers just couldn't handle it. Right? They just couldn't handle it. And so while pricing pressures were both a demand and supply story, if you actually look at all the supplies in the United States, for example, including domestic supplies, supplies coming from abroad, we were actually 5% above where we were before the pandemic. And that was the case when you talked about goods. It was the case when you talked about commodities. It was even the case when you talked about ships. So all this talk about ships, we don't have enough ships. We had the ships. Ships were just parked in the wrong places. Right? The shipping companies weren't used to the new patterns of demand that people had set for ourselves in the wake of COVID. And so if you looked at demand, while supplies were up 5% before the pandemic, demand was actually up by more than 20% from before the pandemic. So I'm not saying that supply wasn't an issue. It certainly was in the context of demand. But most of the imbalances in the economy, and you see the incredible surges in demand in advanced industrialized economies here, most of the imbalance in the economy was generated by this incredible surge in demand. However, we believe that as supply chains caught up, as interest rates went up, supply-demand imbalances would ease, and that would bring pricing pressures back down. That would help control inflation. And it was about that time that you start to hear, let's go back. You start to hear economists introduce a new term into the global discourse, into the dinner table conversation. Transitory, right? Transitory. Don't worry, it's all going to be transitory. Well, how long is transitory? Well, we're not sure, but it'll be transitory, right? It's going to work itself out. Well, what a difference a year makes. China has seen its largest COVID case count of the entire pandemic only in the second quarter of this year, causing almost 3/4 of the country's largest cities, including Shanghai, by the way, which is a major manufacturing hub, home to the world's largest container port, to impose some sort of restriction. In fact, at one point, more than half of the country's economic output was being restricted in some form or another. And ongoing lockdowns today, consistent with Beijing's COVID-0 strategy, is raising concerns that we're not really out of the woods quite yet. This is again threatening global supply chains, putting downward pressure on output and upward pressure on prices. And if that wasn't enough, after almost 77 years of relative peace and security in Europe, on February 24th, the Russian forces of President Vladimir Putin invade the sovereign territory of Ukraine, launching a full-scale military incursion into the Eastern European economy in what was probably the most telegraphed war in all of military history. And so as a result, we move from what economists like to call demand pull inflation to cost push inflation. Because aside from the unspeakable human toll that the war continues to take on a daily basis, and we forget that because the news has moved on to other things, continues to take on a daily basis. Remember, Russia is the world's largest grains exporter, and together with Ukraine, supplies 28% of global wheat, 17% of global corn exports, almost half of the world's sunflower oil exports. The story becomes even more complicated in that much of the Ukrainian crop that you see over there is certified non-GMO. So replacing that lost export capacity becomes an enormous challenge for the global economy. And remember that grains don't only feed humans directly, they're also used in animal food. And so whereas food costs were increasing even before the war, if you look to early 2021, even late 2020, as a result of changing consumption patterns, the invasion triggers even more pricing pressures, with the price of corn, beef, soy, all well up on the year. And unfortunately, we don't expect much relief over the next year or so, given that damage to agricultural lands and the displacement of workers, both out of Russia and Ukraine, has almost certainly disrupted planting ahead of next season. What's more is that as the harvest is now underway in this really critical breadbasket of the world, those farmers, those producers that are still unable to ship their products are going to have a really hard time financing production next season, especially if input costs remain at currently elevated levels. Remember that between Russia and Belarus, that's 40% of the world's fertilizer production. On the industrial side, Russia and Ukraine together are responsible for almost half of the world's crude iron exports used in steel production. Russian slab steel is then sent to Turkey, it's sent to Italy, it's sent to Mexico to make sheet metal parts. Russia also supplies 40% of the world's palladium, 30% of the world's titanium, is a key nickel producer, the third largest exporter of coal, the world's largest softwood lumber exporter. So there are very few industries here that are escaping the pricing pressures, right? From agriculture to autos, aerospace to clean tech, construction to communication technologies, but much of the focus these days seems to be on energy and energy prices. And that makes sense, right? Russia produces 13% of the world's oil, is responsible for about a fifth of global natural gas production. And also don't forget the use of grains and biofuels, right? Now, unfortunately, we are not expecting a swift resolution to the situation in Ukraine. And while prices on the energy side have fallen back on concerns around economic activity, the IEA expects that global oil demand will exceed its pre-COVID peak of 100 million barrels per day sometime in early 2023, thanks to fuel switching from gas to oil. So this is obviously not a welcome development for the world's central banks, because while interest rates can help choke off demand, as far as I know, central bankers don't pump oil or can't plant more wheat for that matter. Now, Russian oil is continuing to find its way into global markets, obviously at a very steep discount, and other producers like Iran, Libya, Venezuela will add some marginal production as well. Additionally, we believe that OPEC's, what we call their Goldilocks band, right? So not too hot, not too cold, for oil is probably at around $100 a barrel. And we now know that Saudi Arabia is more than willing to manage supplies in order to get us closer to that target range. But we expect oil to be in for a period of heightened volatility, with prices here increasingly disconnected from supply-demand fundamentals and more driven by headline risk and the disruptive levels of liquidity that are still sloshing around the system. And we'll talk about that in a moment. Keep in mind that the paper market for crude, so oil futures, is 50 times the size of the physical market. 50 times the size of the physical market. So you got to ask yourself, what's driving prices here? Right? It's not a supply, this isn't a supply-demand thing anymore. So when you throw all those forces together, we expect that oil, WTI, West Texas Intermediate Oil, will have an average price this year of $98 a barrel, this year largely in the bag at this point, before settling back to $84 a barrel in 2023. And that's going to have a slightly moderating impact on core prices as well. On the natural gas side of things, while we know that US prices are relatively low compared to what we're seeing happening on the European side, increased LNG shipments across the Atlantic and lower than normal inventories are continuing to keep upward pressure on natural gas prices, continuing to push US natural gas prices up. We expect that US natural gas prices, so prices on the Henry Hub, will average $7 per million BTU this year before settling back slightly to $6.70 per million BTU in 2023 as production picks up stateside. So that's the commodity side of things. That's great. What does that all mean for the global economy? Well, being closest both economically and geographically to Ukraine, Europe's economy is obviously most vulnerable thanks to immediate risks to critical energy supplies, impacts on inflation, and strains on both business and consumer confidence. Remember that Russia used to supply 40% of Europe's natural gas, much of which actually went through Ukraine, which was also a transshipment point for oil, with about 250,000 barrels per day of Russian oil transiting Ukraine, ultimately destined for the European market. And so Putin's manipulation of the gas market, exacerbated by this summer's drought conditions in Europe, which caused European hydropower production to decline by 26%, are going to keep prices, energy prices in Europe, really, really high. In fact, wholesale electricity prices in Europe have skyrocketed because they're pegged to natural gas. Whether or not the electricity is actually generated from natural gas, the prices in Europe are pegged to natural gas, which is something I think that European regulators are going to have to sort out once we're out of the current crisis. And so economy-wide, spending on gas and electricity in Europe could jump from 200 billion euros before the crisis to almost 1.5 trillion euros over the next 12 months. 1.5 trillion euro. That's about 10% of the size of Europe's entire economy, or the entire economy of the EU. And it's specifically going to hit countries like Germany, right? The region's industrial engine. The UK, where we know that household electricity is much more reliant on gas. So we expect inflation in Europe and in the UK, already pushing the double digits, to stay higher for longer, and that's going to cut into consumers' wealth and ability to spend going forward. At the same time, all this uncertainty will also make consumers in Europe, less willing to run down the savings that they've accumulated over the course of the pandemic, and make companies more cautious about investing in production and supplies. And in fact, that's exactly what businesses and consumers are telling us, right? There's a growing sense of pessimism that's setting in the European market. And so this is going to hit both the demand and the supply side in Europe, and likely means that growth in Europe is going to come to a complete standstill in the context of a much higher price environment in that part of the world. So Europe's in a bad spot right now. Europe's in a bad spot, and we expect the euro area to stay in recession. In fact, we expect the euro area is already in recession as of the third quarter of this year. We expect the euro area to stay in recession into the first quarter of 2023 and stay essentially flat through next year with the balance of risks very much tilted to the downside should Russia decide to fully turn off the natural gas taps to the European continent. Now, in contrast to Europe, the situation in North America is a little bit less gloomy, a little bit. Why? Well, it's the good old US consumer. Coming into the downturn, the consumer, at least in the United States, came into the downturn with a whole bunch of pent-up demand, deferred purchases, for one reason or another. And while wave after wave of successive lockdown forced the consumer in the US to change their consumption patterns, right? Swapping out vacations for Amazon deliveries, restaurant dining for Netflix accounts. It also forced the consumer to put more cash away. Right? You remember that rainy day fund that we talked about a little bit earlier? Well, the skies are getting pretty gray over the North American economy these days, the US economy. And the consumer in the US is still sitting on $1.5 trillion, a huge amount of cash. Households, you can see here, are sitting on $1.5 trillion of what we call cash on hand. And that's acting as a bit of a buffer. That's huge. That's huge. That's basically the equivalent of 3 months worth of, it's kind of insurance on 3 months worth of pre-pandemic retail sales. And so with the consumer in the United States accounting for what, 70% of that country's overall economy, that's a lot of insurance. That's a lot of insurance. Even as government transfers, the housing market, net trade as a result of a stronger US dollar are expected to weigh things down over the next little while. Now, there are signs that the consumer in the United States has started to slow down a little bit. Savings rates we've noticed have fallen back. Energy costs, still high energy costs, are taking a chunk out of discretionary spending. And so you can see that the consumer in the US has had to start to run down some of those excess cash reserves. And that's that perforated line that's coming closer to the solid line that you see over there. And so that's a risk to our forecast. And it's something we're keeping a very close eye on, something we suggest you keep a very close eye on if you have any sort of exposure to the US market, either directly or indirectly, which, you know, I suppose that we all do. So while our base case isn't calling for a technical recession in the United States, and I want to be clear about that because we're an outlier here, we're not calling at this point for a technical recession in the United States. We do expect a whole lot of nothing through the rest of this year and into the first half of 2023. Growth of 1.4% in the US economy, which is our call for 2022, basically implies we're going to see a negative quarter of growth in the fourth quarter of this year before an essentially flat year next year with growth of about 0.6% for the economy as a whole. So while this isn't a recession, and we're talking about a couple of decimal places here, this is very weak, very uninspired, below trend growth for the US economy. You know, the way I like to think about it or talk about it is I think about a bicycle coming to a stop, right? The bike is slowing, it's slowing, it's slowing, it's still upright. It's starting to wobble, and even just the tiniest pebble can cause it to tip over. One of those pebbles, the labor market, because I actually think that one of the biggest risks facing the US economy, the North American economy, is the strength that we're actually seeing in the labor market. Let me explain what I mean by that. When the pandemic hit, unemployment skyrocketed. In the US, we hit like 15% unemployment. Canada wasn't far behind, but now suddenly unemployment is back to where it was before the pandemic. And labor force participation is also back to pre-pandemic levels. In fact, in Canada, labor force participation is even above pre-pandemic levels. In the United States now, there are almost 2 jobs for every unemployed worker. And so with demand still relatively solid in the US, companies are having a harder and harder time not only attracting but retaining that critical talent, the skilled labor that they need to meet still relatively strong customer demands. And that's exactly the feedback we're getting from our customers. There's a growing frustration out there that labor forces, labor markets have tightened so much so that anecdotally we're hearing of stories of people leaving for opportunities elsewhere for up to 40% more money, 40% more money. It's got to give you some sense of the imbalances that we're seeing in labor markets and of the power shift from employer over to employee. And so with inflation already at multi-decade highs, ongoing pricing pressures coming from the impacts of the war, energy disruptions, China's COVID-0 strategy, there's a very real risk here of falling into what economists refer to as second round effects on inflation via higher future wage growth. Let me explain what I mean by that. Once inflationary expectations take hold, and people expect it's going to cost them more money to maintain the same quality of life, maybe just increase their quality of life just a little bit, they're going to turn around and ask their bosses for more money, right? Because companies may exist, companies may report in nominal terms, but employees, consumers, we live in real terms, right? We've got to adjust for inflation. And so, by the way, if you feel poor, it's probably because you are. Now, given the power shift we just talked about from employer to employee, do you think businesses are in a position to say no? Are you in a position to reject your employees' wage demands? And once that happens, that's when we run the risk of falling into an inflationary cycle, right? You ask for more money because it costs you more to live. Your boss has no choice but to say yes and give you that wage increase. Now there's more money in the system chasing the same amount of goods and services, maybe even less because of supply chain constraints. Prices go up, cost you more to live, you got to ask for more money. You ask for more money, you get your wage increase, and so on and so forth. And you see how that happens. And we're seeing that happen all over the world, in markets all over the world. In the United States now, average hourly earnings are up 5% versus where they were last year. Canada, it's pretty much the same. And that doesn't even cover the cost of inflation. And so what do you think that does to expectations going forward, both in terms of what employees are expecting to get and what employers are expecting to pay? In Canada right now, more than half of businesses have said that they expect to increase wages over the next year or so. And it's why we're very concerned about rising energy and other costs feeding through to higher wages and eventually on to core prices. Even in Europe, by the way, where unemployment is down to historically low levels. Unemployment in the euro area now is almost 6.5%, 6.6%. That's really low for Europe given kind of the regulatory environment there. There's going to be intense pressure to start hiking wages as inflation continues to erode consumers' wealth and ability to spend. So much so that Germany's largest labor union not long ago floated an 8.2% wage increase. 8.2% wage increase in a market that is absolutely obsessed with price stability. I find that astounding. It's unprecedented. And so the possibility of falling into this inflationary cycle raises the risk that central bankers are going to have to raise interest rates more than they previously expected, more than we previously expected. And that's going to have grave consequences on the growth prospects that we just talked about. Now, for now, we have no reason to believe that the Fed won't continue along its resolute but fairly well-managed tightening path. We expect the Fed funds rate to peak by the end of this year, some point early next year. Our call a few months ago was at 4%. Probably it's going to be a little bit higher than 4%. Markets now are expecting 4.5%. We expect it's going to peak somewhere around there in that kind of area code, stay flat through next year, before only returning down, pulling down, coming back down once inflation is under control in 2024. Additionally, we know that accelerated balance sheet reductions, what economists like to call quantitative tightening, is going to have the equivalent impact of a 50 basis point increase through next year. Now, the Bank of Canada, I won't say much about the Bank of Canada, but I will say, I think the Bank of Canada, for its part, deserves a huge amount of credit here, a huge amount of credit. First of all, for calling this thing what it is, and that there's no way this thing is transitory, and for hiking rates well ahead of its other G7 counterparts, which we believe may allow it to avoid any drastic moves going forward. In fact, you saw the bank increasing rates, as was mentioned earlier, today by a less than what the market expected, 50 basis points versus the expectations of a 75 basis point. We don't think the bank is done, but the bank's early move has allowed it to be a little bit more subdued than what we're seeing in some of its G7 counterparts. But we expect the bank to stay in lockstep with the Fed, temporarily overshooting its, what we call its neutral rate, in order to bring inflation back in line before only bringing interest rates back down again in 2024. Now, the situation in Europe is a little bit more tricky. Higher inflation expectations in Europe are adding to pressures on the European Central Bank to continue with its increasingly aggressive monetary policy actions, despite the expectation that the zone might be moving closer and closer into an increasingly deep recession, if not in one already. Also, while we know that the European Central Bank doesn't officially target the exchange rate, it is not lost on officials in Frankfurt that a higher US interest rate is leading to a depreciation of the euro. And that causes the zone to import more inflation into the region. So they've got to do something, right? They can't just sit there. They've got to do something. It's almost like the currency wars that we saw in the aftermath of the global financial crisis, only this time in reverse, right? Countries are looking for stronger currencies in order to ward off any potential inflationary pressures. But we think that the European Central Bank will struggle to keep up with the Fed, given the need to more delicately balance the impacts of the war on inflation against any impacts of the war on growth and confidence. Because there are very legitimate fears here that the ECB, that the European Central Bank, may be hiking on the cusp of a recession. So you can bet that the US Federal Reserve is watching the ECB really closely, watching the Bank of England really closely, wondering whether it's looking at some future version of itself, or questioning whether there's a very real risk here that central bankers might be pushing us into an economic downturn. And then the question for me, the interesting question for me becomes, what do central bankers do when inflation is still very high, but very clearly rising, and unemployment is still low, but very clearly, inflation is still high, but very clearly falling, and unemployment is still low, but very clearly rising? Because there's a good chance we're going to be in that situation before long. And remember, monetary policy comes with a lag of between 12 and 18 months. So it's not an enviable job that these central bankers have. It's a very fine line that central bankers are walking here. A very fine line indeed. Because up until now, cheap money has been letting governments spend. Well, it's been letting governments borrow, which has let governments spend. It's underpinned historic stock market valuations, abundant credit to the private sector. Since the collapse of Lehman Brothers, we've had more than 1,000 global interest rate cuts. And central bankers have injected more than $23 trillion into the global economy through various QE measures. A sudden change to that will be painful, hitting equity, credit, housing markets in certain economies. Hello, Canada. Taking the shine off of certain commodities, leading to currency instability. So what happens in financial markets if central bankers move too far, too fast, or if they just stay in restrictive territory for too long? Like, to get back to our analogy here, our biking analogy, the training wheels are coming off this thing. There is no more policy support available anymore for the economy. And any government that tries to implement policy support is going to get hammered by markets, hammered by voters, and we're seeing that play out. We've just seen that play out in the UK. High real yields won't only lead to higher borrowing costs, but they're going to make more risky assets relatively less attractive on financial markets. And this could expose over-leveraged corporates who've spent the last number of years loading up on unproductive debt beyond what's sustainable. You know, Warren Buffett used to like to say that while a rising tide raises all boats, it's only when the tide goes out that you see who is swimming without their shorts. Well, the tide is going out now. The tide is definitely going out, and it's the swimming without shorts part that I'm a little concerned about. Because at a global level, non-financial corporate debt over the course of the pandemic has jumped from $76 trillion to a phenomenal $88 trillion. $88 trillion. That's 101% of the size of the global economy. Think about that. Corporate debt now is bigger than the size of the entire global economy. And that suggests to me a much greater than usual corporate sensitivity to higher interest rates and presents a pretty serious vulnerability for the global economy. Government debt has ballooned by even more than that amount over the same period. And that's raising concerns around some of the riskier euro area sovereigns, like Italy, with a debt to GDP of 150%, which was a big beneficiary of the European Central Bank's bond buying program and historically low interest rates. And so this is going to evoke painful memories for European Central Bank officials of the last time they raised interest rates back in 2011, just as the region fell into a debt crisis. Higher rates in advanced economies will also lead to a reversal of capital flows into emerging markets, many of whom came into the downturn with high debt levels already, and who spent the last number of years experimenting with larger budget deficits, unconventional monetary policies. The higher US dollar is also going to make things more painful for many countries that have a significant share of their debt denominated in US dollars, right? It makes that debt harder to carry, harder to serve, more expensive to service. In fact, there are now 16 sovereigns, 16 governments on the JP Morgan Emerging Market Bond Index with spreads above 1,000. That's like crisis territory. A year ago, it was 7. In 2019, it was only 5. Higher food, higher energy costs are another pressure point for many of these emerging market countries where household spending on these staples makes up a larger share of total income as food and fuel insecurity grows and regimes struggle to contain their inflationary impact. The possibility, the prospects of social unrest also increase. We already know of situations in the past where higher food prices, higher energy prices have led to political instability. Think about the Arab Spring, for example. So if the global financial crisis in 2008 was an effect of Greenspan's response to the recession that never happened in 2001, as many people say that it was, as Greenspan himself says that it was, then I worry about the scale of any consequence to the extraordinary amount of stimulus we've been pumping into the system over the last number of years. So yeah, that's kind of how we see things. To say that 2022 hasn't played out the way most of us would have expected would be an understatement. Inflation above 40-year highs, war in Europe, tensions in the South China Sea are only serving to compound the lingering effects of a global pandemic. The US is going to see weak, uninspired, below-trend growth next year. Call it what you want. It's a recession, it's not a recession. I think we forget. I don't even think we're talking about the same terms when we're throwing these terms around. They're going to see weak growth. That's the bottom line for companies. Even Canada, which has been somewhat resilient over the last little while as a result of commodity prices, is expected to join the US on this lower growth path. The UK, Europe, meanwhile, is in for a much rougher ride thanks to surging energy costs, declining consumer purchasing power, rising business pessimism in the region. While the Chinese government is leaning heavily into its economy, and other developing economies are having to deal with higher cost of food, higher cost of fuel and energy, simmering social tensions, rising debt pressures in the context of an increasingly tight global credit environment. And so if you throw all that together, you get the global economy falling, growth in the global economy falling to 2.2% this year, followed by growth of only 2.6% in 2023. Remember what economists predicted at the beginning of the year? So while we still do believe that the global economy manages to sidestep a recession, that is certainly not going to be the case for all markets. What's more is that growth with a 2 handle, if not recessionary, it's pretty darn close. It's maybe as close as you can get, right? That bike is slowing. It's still upright, but it's starting to wobble. And the path ahead is absolutely littered with pebbles, right? Slowing consumer demand, particularly in North America. specifically in the US. Russia fully turning off the natural gas taps to the European economy. Central banks moving too far, too fast, financial market contagion, asset repricing, sovereign corporate debt default, social unrest. So yeah, the list of risks here is quite significant. And that's reflected in the relatively low weight that we've assigned to our base case forecast. Probably about as low a weight as you can assign a base case and still call it your base case. I think we have it now at like 60%. In fact, if you run what we call a scenario weighted forecast, you do get recession in the US, in Canada, in a number of systemically important markets, Brazil, Mexico. So what does all this mean for Canadian companies? Well, all of this volatility has obviously complicated the operating environment for many parts of our economy. Generally, we think that Canadians will face headwinds from tighter credit conditions. As rate hikes flow through, we expect a gradual weakening of Canada's domestic economy. In that context, though, trade should be a net contributor to growth, helped by the weaker Canadian dollar. Commodity exporters are generally benefiting from tight global supplies and still high prices across much of the commodities complex. As countries are looking for energy security, for example, and renewable energy at that, the current geopolitical context offers opportunities for growth. Agricultural exporters from Canada, likewise, are going to remain absolutely critical to feeding the world, as long as the war in Ukraine continues, and I'll say probably even beyond that. While transportation and logistics constraints have prevented some agricultural exporters from really realizing the full benefits over the last couple of years, together with higher input costs, we know that shipping rates have now come down. Supply chain constraints have come down and are significantly lower than where they were exactly a year ago today. Crop producers are expected to benefit from a record yield this harvest season. Demand for wood products, meanwhile, is going to weaken. And that's a significant headwind for this part of the country. Consumer spending is rotating increasingly back from goods towards experiences, right? Services. And higher interest rates are going to take a bite out of what we call residential investment, building. The same is true for producers and exporters of manufactured goods, who are also having to contend with tighter conditions in the labor market. For other sectors like aerospace, autos, tourism-dependent sectors, conditions are actually improving in a post-COVID environment. So while the reasons may vary, some sectors are actually positioned for growth, are actually positioned for opportunity. But you need to keep your eyes on those pebbles. And what that suggests to me is that in this age of increasing uncertainty, we need to be spending more time focused on scenarios, risk-weighted forecasts, thinking through the what-ifs. And so, for example, if your downside scenario carries with it a weight of 35%, you should be spending 35% of your time thinking that through, considering what that means for your business and what you're going to do about it. At the same time, you need to make sure that your capacity can keep up to be able to answer the door if and when opportunity comes knocking. So watch capacity, invest in order to create that capacity, especially at this particular point in the interest rate cycle. Inflation is absolutely going to be an issue, as are labor constraints, but they should be motivators for more investment. Invest in your plant, property, and equipment. Invest in your people. Invest in what it is that makes your business grow, what makes your business unique. And that, we believe, should help you be able to withstand the risks that we certainly see coming our way over the next couple of years, but also put you in a position to take advantage of the opportunities that are no doubt ahead of us. Thank you.
Thank you, Stuart. Maybe I don't need this. Can you hear me? Can you check, check? There we go. It is 1:32:33. I've been told that we can push back the schedule by about 10-15 minutes. So what says 1:30 on your schedule will now start at 1:45. Sounds good, George? Head nod. Okay, 1:45. So the 1:30 session will start at 1:45. Stuart's going to answer a few questions.
Sure.
Does anybody, I'll start with the room. Does anybody have anything they'd like to ask Stuart? Perhaps up here, up front. You want, here, I'll come down there. Here you go. Hi.
Thank you for a great presentation. The question is, do you have any comments about green inflation in relationship to price fixing and monopolization of certain commodity producers like the grocery stores and the competitive issues there? Can you speak about greed inflation?
Greed inflation. Oh, greed inflation.
Not green. Greed.
Sure, I have plenty of thoughts about that. You might have to buy me a pint after, and when we're not still on camera. I think businesses are doing what you would expect businesses do in a capitalist society. Is like the risks are there, the impetus is there to raise prices and grow your margins, and so you're going to do it. At the same time, let's understand where it's coming from, right? Like the input cost of businesses has increased. Whether you're talking about labor, whether you're talking about materials, if you're talking about imports of food, or you're talking about imports of other commodities, costs have gone up. And we know that because if you look at, an early indicator for us of inflation, of consumer price index, is the producer price index, which is a little bit, one step up the chain. And if you look at that, you see that producer prices have been increasing as well, right? So it's not as if, it's just the retailers that are kind of inventing these inflationary costs and tacking it onto the final bill of sale. Are there companies, are there industries that are taking advantage of it? I would say probably. Will we have a better sense of that when we start to see prices come down? You bet. I mean, we expect prices to come down in North America towards the end of next year into the first half of 2024. We expect prices to start to come down as interest rate increases. Monetary policy, as I said, comes with a lag. So as that eventually starts to flow through, the rate increases we're seeing now aren't going to actually flow through the economy until about a year from now. Fiscal policy will be pulled back. We'll have quantitative tightening. The year-over-year price comparison is going to, be in the favor of inflation moderating. Reduced demand is going to bring prices back down. So we do expect to see prices come back down. And when we do, we'll have a better sense of, how much of that really was happening inside of the economy. But yeah, I would say that without a doubt, there are industries, there are producers that are taking full advantage.
Stuart, back of the room here. Anyone else have a question next? Show of hands. There we go. Okay. Perhaps just your name, where you're from, and then your question.
Tom Zaban, Reliable Controls Corporation, Victoria, BC. Stuart, great presentation. Really liked your analogy of the tide going out and looking to see who's holding up shorts if they have it. What does the EDC look for forecasts for the next 2 years, 2023, 2024, for bankruptcies in Canada? Thank you.
That's an excellent question. We don't have a forecast for bankruptcies. It's not part of our mandate. It's not what we do. Of course, we have some assumptions that go into our model, that go into our forecast. The nice thing is that we're seeing is that bankruptcies actually have been a lot lower than what would have been expected, even if you look through the last few years during COVID. Some of that is thanks to government support, but you would normally expect, as I'm describing, to start to see some of those, what we call zombie companies, be exposed. And so you will start to see bankruptcies, I believe, increase, headed into a tighter credit environment, headed into an environment where consumers aren't buying as much as they once were. Probably depends on the sector you're talking about, very sector specific. So I would say more strains likely on the goods producing sides rather than on the services side. But yeah, I would expect to see an increase in bankruptcies. I don't have a number for you because it's not a forecast we produce, nor do we publish. But that's a good question, and it's something to focus on. I think that if you're looking for early warning indicators, these are the types of indicators you want to be looking at.
Thanks, Stuart. Just up front here.
Yeah, Stuart, a great presentation. What is your feeling about stagflation with regards to what we're seeing now? And is this eerily kind of looking like the 1930s again with all of the activities going around the world?
So I'm not a fan of comparisons to the 70s, the 30s, because I think actually that structurally, the global economy is very different from what it was back then, and so we have incredible technological evolution. Investment in things like automation, which ultimately should help to pull prices down, pull your unit prices down. I don't necessarily agree with the comparisons that you sometimes read about to some of the other decades. But stagflation, absolutely. I stay away from, as I mentioned earlier, the terms, because I think sometimes, we get lost in these terms and we no longer are even talking about the same thing, whether it's recession, whether it's inflation. Is it a recession defined by 2 consecutive quarters of negative growth? Is it a recession as defined by the NBER in the United States? Like, what is your definition of recession? And then we kind of talk past each other. Stagflation, to me, weak growth in the context of higher prices, yes. I mean, and that's exactly the type of scenario we're describing in Europe. If you see growth level off and you see prices continue to year over year increase at 7, 8, 8.5%, I suppose technically that is stagflation. And that to me would be one of the pebbles that we would have ahead of us is, yes, if we were to fall into this stagflationary environment, in many ways it could be a bit of a downward spiral, right? It's self-fulfilling in that way.
Over here, Stuart. Final question is going to go to Scott Harrison. This is a councillor, just re-elected to his second term with the lovely town of Qualicum Beach. Scott.
Yeah, so recently Cynthia Freeland in a speech talked about the conscious decoupling from autocratic governments in terms of where we actually source out some of our economic inputs. I'm wondering, just from like a Vancouver Island perspective, if that is something that's going to move forward, and I suggest what happened to Hu Jintao at the Party Congress sort of indicates that China is going to be a little bit hard-edged. What economic opportunities for Vancouver Island on a sectoral basis might we see if we do see that conscious decoupling of the Western economy from autocratic regimes? Thank you.
Oh, there's a lot in that question. So the first thing I will say is not Hu Jintao, but Xi Jinping. But I understand why Hu Jintao is on your mind, because if anybody saw that video circulating of the Chinese Communist Party Congress was quite chilling, and speaks to the issues that I think China is dealing with, notwithstanding this is a structurally faster growing economy than most of our advanced industrialized trade partners. This is an economy that is facing significant risks. I will say, these COVID zero lockdowns, in my view, this is my personal view, are probably less about COVID and more about keeping a tight control of the population. In China, the quid pro quo was always, I give up my personal freedoms for economic well-being. And while suddenly now Chinese growth, we're expecting it down in the 2s and 3%. I mean, that is far lower than what China requires in order to keep its population, the wealth of its population continuing to grow. So, there was a lot that came out of that Communist Party Congress that's quite chilling. I note, for example, I took a panned out view of the picture of the Congress and noted that you had to really struggle to find a woman there, which, like, dudes were smart, but if you're going to cut out half of the population based on their gender, this is not a society that is going to be able to compete longer term if this is kind of indicative of the thinking. So a lot of worrying signals. And so what does that mean for growth or for trade partners? I'm not going to comment on Minister Freeland or Government of Canada policy. What I will say is I'll just look to the data, forget the policy. I have a hard time with this notion of reversal of the trends towards globalization, friendshoring. I mean, I think in a capitalist system where companies are incented based on, based on return that they provide to their investors, it's really hard to prevent, like, all it takes is one company sourcing its factors of production at a lower cost, and then others will have to follow, right? It's just the way the capitalist system works. So while we might see, and every so often, whenever there's a crisis, we see globalization take a bit of a step back, and then everybody gets all up in arms, like, oh my God, globalization, reversal of globalization, we're going in the opposite direction. It's like, eventually, longer term as a trend, I just don't see that as a long-term trend reversing. I just, unless we fundamentally change the economic system that we're all a part of. That's my personal view based on the data, no policy judgments there.
Scott promised that would be a quick and simple question. That was a lot bigger than that. You promised.
It's a great question.
That concludes this opening presentation with Stuart Bergman. How about a round of applause for our first speaker today? And I believe Janet Bonaguro has a gift that she's going to present to you, Stuart. Thank you so much for being here. Stuart's off to Vancouver to give a similar presentation, I believe, later today or tomorrow?
Tomorrow, yeah. Yes.
Well, thank you for being here. On behalf of VAIA's board and the committees that bring this conference together, I want to thank you and EDC for being here and taking to note on a micro scale. Island Good and VAIA are doing some minor things to kick some of those pebbles out of the way with our Island Good products to help our food and manufacturing products succeed through that time. So I wanted to thank you and provide you with a sample of what we're doing here on Vancouver that is Island Good.
Thank you so much.
Thank you.
Thank you. Thank you.